is a presentation of TFNN.
Hey, welcome everybody to the Options Hour. Every Tuesday, 12 noon Eastern Standard Time. My name is Don Kaufman from ThinkorSwim, from TD Ameritrade, the host of the Options Hour. Really here to answer any of your option-related questions. And of course, you can call us, you can talk about a stock, options, futures, commodities. We will discuss all of that. So, as usual, you can call 877-927-6648, and we will answer your options-related questions. Anyway, with that, let's give you guys kind of a quick rundown of the marketplace, what we're seeing today, what we hope to see the rest of the day, and we'll kind of move forward from there. So again, welcome everybody to the Options Hour. Again, my name is Don Kaufman, and what you're seeing, if you guys are watching the TFNN live TV, is a screenshot of ThinkorSwim from TD Ameritrade. And again, we're going to be answering some questions live here on the air. And as usual, give us a call, 877-927-6648. We are, of course, here to really answer any of your questions. If you're thinking about building an option position, if you got an option position that's on right now, not really sure what to do with it, give us a call. And, if you're thinking about putting a position on, whether you're bullish, bearish, neutral, we can possibly help construct that a little bit more accurately for you. We have a lot of questions lately about the weeklies. I've got a couple of emails here I'm also going to read off and answer live on today's show. Of course, by the way, if you guys, if you're sitting at home and you're just not the call-in type, I'm reading the Tiger Den right now, so hello everybody in the Tiger Den, and hello G7. Happy Tuesday. How is Tuesday a happy day? I don't know. The only reason Tuesday is kind of happy for me today is the market is finally, one time here out of the last 20 days, the market is finally trading my way. It hasn't happened in a very long time. And by the way, I'm not necessarily, long the marketplace, but I am short gold, and that's been the painful trade. I heard last night. I just flipped on CNBC right after the close. I was eating some lunch right after the close of the market here yesterday, and flipped on CNBC, and again they're talking about gold cracking over 1,900. That just really screwed up my lunch. I don't know about you guys, but that didn't really work for me. Hey, if you're long gold, you're looking pretty good. You guys can also, if you don't want to chat with me here in the Tiger Den, you can shoot me an email. My email is D Kaufman, it's D as in Don, K-A-U-F like Frank, M-A-N, at ThinkorSwim.com. So by all means, shoot me an email here, and I'll try to read it live. I am reading my email, reading the Tiger Den, reading everything in real time over here. So let's give you guys kind of a quick rundown of the market, and give us a call, because we're here to answer your questions. E-mini S&P 500 futures up 22, NASDAQ futures up 51.50. NASDAQ is flying today. Dow futures up about 193 right now. Of course, the VIX is down about 380 on the day. And for those of you that have not watched every single tick of the market today, I'm going to tell you. So this morning when I woke up, I live on the West Coast. I'm at Scottsdale, Arizona. I'm on West Coast time. I wake up every day anywhere between 5:30 and 6 and take a look at the futures. Futures this morning were up 7, but it was kind of a scary open. We opened up and sold off a little bit, and then just spurted back up over here. In fact, when we sold off this morning, it looked a little scary because gold rebounded off of its lows. Oil started trading down. Oil's been trading in tandem with the S&P 500 here. So, oil started selling off. The VIX started rallying back up, and I'm like, oh, no, not again. I mean, how many really big down days? Listen, I'm a contrarian. I'm always going to be a contrarian. You get this many down days in a row, at some point, you look for some type of a bounce, some type of a rebound. And, it's not everything is participating in this rally here. No question about it. There's definitely some laggards out there. But ultimately, it's a fairly strong rally underway right now, other than, of course, gold. The other thing that we're not seeing the action we'd like to see in right now, of course, is bonds. Bonds are down ticking. The ZB, which is the 30-year bond, is down about 16 ticks. The 10 years is barely off, and that leads you to TLT and TBT. TLT is down about 63 cents in the day, which is, that's a real nominal move. Typically when you see these large up days, and there's a lot of conviction behind large up days, what you see is a flight from quality back into the markets. Quality being, we'll call that the bonds. If you think bonds are quality, I can't in good conscience call bonds quality anymore at these prices. I can't do it. But again, those are my positions. And if you guys, if you don't take a look at a lot of charts on bonds and such, I'm actually pulling up a chart here. It's a 5-year daily on the ZB, the /ZB, and /ZB is the ThinkorSwim quote for, of course, the 30-year U.S. Treasury bond futures. And those bond futures, if you hadn't seen this, kind of zoom in. They've ticked as high recently, and kind of zoom in and zoom out. They've ticked in as high recently, over 140. Now, to put this into perspective, so the bonds themselves have ticked over 140. Back in the middle of the crisis of 2008, 2009, the very high tick, when you thought the world was coming to an end, the very high tick was 141.28, and we pretty much crested right up to that 141 level on that 30-year bond. And people are like, what does this bond matter to me? Listen, I'm trading S&P 500. I'm trading GE. I'm trading, Apple. What are the bonds? I don't want to hear about the bonds. I don't trade bonds. If there's one product that influences every single individual, okay, that listens to this program, it's those bonds. I mean, more so than any other product that you may think that you have a position on here, that you may think you have a trade on, you have risk and interest rate risk at all times. And it's just a critical understanding. The interesting thing is that many people, of course, take shots in Apple. They take shots in some of the major equities out there. But again, bonds and obviously notes have influence, and interest rates ultimately have influence in really all of our lives. Yet very few retail clients look at this product or trade this particular product. So again, bonds are just down tick now, down about 16 ticks. Not a huge sell-off in the bond market here today. So this is going to be a quiet show. Not a lot of people calling right now, but if you guys are available and willing to give us a call here. In fact, you want to talk about some of the trades you've got on. And, a couple of weeks ago, we really wanted people to call in and talk about trades that were absolutely horrific. If you've got a really horrific trade, then we definitely want to hear from you. But ultimately, you can give us a call in regards to really any trades that you're interested in discussing. Of course, the number here is 877-927-6648. All right, so let's get in here, and we're going to answer a couple of questions. One of the email questions right off the bat, then I'll talk a little bit more about the markets in general, and we'll also discuss some of the positions we've been talking about the last few weeks over here, constructing some option trades. So one of the questions I kind of wanted to answer is a question came in from Frank. By the way, Frank, you have an email address, but it's the wrong email address. You've actually got somehow my personal email address, but remember, my email address is dkaufman at thinkorswim.com. But anyway, let's address your question here, Frank. The question is, Don, if there's no options offered for a $50 stock, what determines the initial price for a call or a put writer? Okay. So, by the way, thank you, G7, for listing my email address in there. So, basically, the first question is, you got no options offered. And this happens once in a while. You get an IPO, like LinkedIn came out recently, and an IPO, and people always ask it. They're like, how do they know what the market is on an option at that point? So, I'll give you guys, I guess, just a little insight to the market-making side of the business. The first thing you have to understand about markets and markets in general here. All right, when I say the first thing you have to understand, I'm looking at the spiders right now, and I'm going to go ahead and I'm going to open up the October options. And you'll take a look at the October options, and you'll see markets. For instance, I'm looking at the 116 calls in October. The market in the 116 calls, there's 59 days to expiration, is $4.89 by $4.90. Okay, there is a 1 penny wide market on a $5 option. Now, if I click directly on that option, a little letter after the bidder offer of that option, you can see that option is now displayed literally through 10 different option exchanges. All right, so now the market's 489 again by 490. This is a $5 option as a 1 penny wide market. And if you take a look, okay, market makers today have almost absolutely no advantage over a retail client. All right, years ago we used to make marketplaces wide, meaning that, you know, when we first made markets on the floor, we're making markets $2, $3 wide. I mean, I remember one market that was $17 bid, offered at 20, a $3 wide market, meaning if you wanted to be a buyer, you'd have to come in and buy somewhere near the range of $20. And if you wanted to be a seller 2 seconds later, you sell that option for 17, you know, and it's just, you got just absolutely crushed in the middle of that. That's what market makers, I mean, that's why market makers are market makers. They get to keep the difference between the bid and ask. Today, the difference between the bid and ask is literally 1 penny on most liquid products. Okay? So think about that, if you will. And I know we've got a caller in just a minute, and we'll get to the caller here in just a moment, but think about that, if you will. There is no middle price in there so much as 1 penny. So the reality is market makers today still exist. You need liquidity providers on either side of the marketplace. So why do you need liquidity providers? Well, you need people to be a buyer when nobody else wants to buy. You need people to be a seller when nobody else wants to sell. If you're a market maker, you have to make a fair and two-sided market. Meaning, if I want to quote spiders right now as a market maker, I have to put a two-sided trade up there. I got to be willing to be, both a buyer and a seller. So I have to make a market of 489 by 490. But the way that liquidity works today is whoever posts, the market-making firm that posts the biggest bid or biggest offer gets the vast majority of the order flow. So number one, as a market maker, you have to post the tightest market possible. Because if you post a market here, this market's 486 at 488 right now. If you post a market, 450 by $5, nobody's coming to you. Think about that. If I'm 450 by $5, who wants that price? It's the worst price in the world. It's 50-cent wide market. But if you post a market, I'm 486 by 488, yeah, they're going to jump all over that, you know, because it's a penny, literally a 1 penny in the middle. So not only do you, as a market maker, have to make unbelievably tight markets, you also have to be willing to trade, okay, hundreds, if not thousands of contracts on either side of this. People say, well, how many right now, this market, you could buy these this option here for $4.85. How many can you buy at $4.85? Well, you know, one exchange has 1,075 offered at that price. So if you want to buy 1,075 and you literally click send on 1,075 contracts, you will fill 1,075 contracts. How long will that take? It's sub-second. I mean, it's literally like, you know, microseconds out there today to be able to get these fills. By the time you get the order notification back, you're about 0.2 of a second. But literally, you're filled now, not even thousandths of a second, in millionths of a second is how things are literally measured today. So you got to kind of keep that in perspective there. So the question kind of looms, you know, who determines the initial, you know, price on these things? Well, it's supply and demand. In effect, order flow coming in, buyers and sellers literally set option price. But if nobody has ever traded the options before, what they do is they look at the stock price and movement of the stock price, and you're able to derive, using, it's kind of a reverse engineering from a Black-Scholes model, you can actually derive, okay, volatility based on stock and start to actually, you know, apply that to options. But the best thing that they do is, as a market maker, when you're first listing options on a product that never had options before, you make your bid and offer rather wide to get a feel for where that marketplace really is. And what happens is, as soon as buyers and sellers come in, so you open up the marketplace, you open it up wide, as soon as buyers and sellers come in, you start to tighten up your marketplace, just like the spread on a football game. Works the exact same way. So I'm going to jump to our first caller. And again, if you guys would, you give me a call. Why? You have questions, you know, stocks, options, futures related. Give me a call, 877-927-6648. I'm going to jump to our first caller. It's Brian. Looks like Massachusetts. Got a question about spiders. You there, Brian?
Yeah, I'm here.
Hey, how you doing?
Very good, yourself?
Good. I'm hanging in there. You know, as usual. How's everything going there? You got a question on the spiders?
I do.
All right. What do you got?
I know Larry said money is a lunar date, and we're going into a market on a Friday with Bernanke going to speak. I'm just wondering how I would play a downside on the SPY. If I wanted not just to buy some puts on it, how would you play that?
All right. So you're looking for some type of a bearish position here in the spider.
Correct.
All right. Is that just between now and the end of the week, or are you planning on holding this for a period of time?
I probably would do like the September. It could be the SPY, it could be the Qs, it could be the IWM.
Okay, so let me give you a couple different ideas. One thing is, I'm going to give you a few different ideas, but the one thing that you have to be able to determine is kind of your level of aggression in this trade, meaning like I'm really aggressive and pretty sure the spider is going to trade down. If you're pretty sure it's going to trade down, you can utilize like an in-the-money put spread. If you're kind of like, hey, you know, I think we're going to trade down, but if we stay flat, I'm going to make some money, I could actually sell an out-of-the-money call spread. And I'm going to give us a combination of the two. So we'll start with the least aggressive of the trades. The least aggressive of the trades would be go out and, for instance, to sell like a 117, 119 call spread on the spiders for the month of August. And that is selling the 117 calls, buying the 119 calls for like a 94-cent credit. So it's a $2 wide spread, 94-cent credit. Obviously, the most you can make on this thing is 94 cents. $2 wide spread. It is what it is. I mean, the credit's not half bad. If the market stays anywhere under 117, obviously you're profitable. You keep the 94 cents. The market sells off big. You still only make 94 cents. It's a less aggressive trade, but the probability is pretty decent in it. And you're familiar with selling call spreads?
Correct.
All right. So that's obviously one option in there. The next option is, again, it's a little bit more aggressive here. And I'm going to see if I can construct a decent one. We'll look at like a 116, 113, for instance, put spread. So you're buying the 116 puts they're literally in the money right now. The 116 puts are in the money by about $1.10. Okay, the 116, 113 put spread is trading for $1.21. What's interesting about this spread is you're buying a spread. All right, a $3 wide spread that has intrinsic value already of about $1.10, yet you're only paying $1.20 for this particular spread. How much can you make on the spread? Well, obviously it's a $3 wide spread. You pay $1.20 for it, so you can make $1.80. In terms of probability, also not half bad. All you need to do is by September expiration, if we're trading below 113, you're golden. The reality is, though, if we trade down big in the next week, this spread is not going to make the full $1.80, so you're going to need a little bit of time decay associated with this trade. But you can get a pretty good bang for your buck here in the next, let's say, 2 weeks with buying an in-the-money put spread. So those are just two alternatives. You're looking for anything a little bit more aggressive than that, or you like one of those?
Yeah, those are good.
Yeah, I mean, there's a lot of different stuff you can do. The one thing I'll warn you a little bit away from, if we trade down right now, okay, volatility can pick up, but you got to be careful. Like, I probably wouldn't utilize a calendar spread, because if we do not trade down, all right, and the market actually rebounds, what will happen on a calendar spread is not only will you lose money on the calendar, but you'll lose money because volatility will contract if we rally. So there's a lot of risk right now in calendar spreads. Your best bet, whatever you do, stick to some type of vertical strategy right now, some vertical spread strategy. Calendarizing strategies right now, again, a lot of risk.
All right, very good. Appreciate it.
Yeah, no problem, no problem. You got any follow-up questions, fire at will. We don't have a lot of callers on the line today, but anything else you got for us?
Out of all the indices, in terms of options, which one do you think is the weakest?
Oh, all the actual index products, in terms of which index. I mean, that's kind of like on a day-to-day basis here, or you're talking about in the next couple of weeks. What do I think?
Next couple of weeks, like based upon what you see in terms of puts and calls, whether it's the Qs or the small caps or the SPY.
I mean, if you think the market's going to break down right now, the NASDAQ has really been kind of leading the pack on this breakdown. So every day that we're down, the NASDAQ's volatility is actually up. Above and beyond, of course, the S&P 500. The Russell, to be honest with you, I haven't even traded the Russell in a while. I used to trade IWM all the time. It kind of fell off my radar screen a little bit. I kind of go like that, though. I'll trade like a ton of spiders and kind of let that, then let something fall off, and then all of a sudden I'll be back trading IWM. So I haven't traded IWM all that much in recent times, and obviously its volatility is a little bit higher, So it's something to think about. If you're looking for more volatility, IWM is going to have more vol than both the Qs or the S&P. So it's kind of more what you're comfortable with. Obviously, the NASDAQ, though, is going to give you pretty good bang for your buck also in terms of volatility. IWM being the highest vol at about 46%. NASDAQ is sitting right now about a 40% vol as well. And, of course, the S&Ps have dropped off a little bit here today. They're down to about a 38 vol. So something to kind of keep in perspective there. It's more about, your directional bias in here. I got to tell you, I think that we're a little bit oversold. I think that bonds need to sell off a little bit, and if bonds sell off, money could come in a big way here to the S&P 500. So that's a relationship that I'm watching. I'm not just a purely directional guy. I'm trying to associate kind of one product to another.
I appreciate it. Great.
Yeah, Dan, thanks for giving us a call today.
Thank you.
All right. With that, we'll jump to another caller here in just a second. But some interesting kind of questions here. A lot of people are on edge, of course, about the Fed. I've kind of made the decision that the market right now it's not just trading off the news. The market ultimately makes up its mind before any news, anything comes out. I mean, a lot of people looked at the downgrade of S&P downgrading, of course, the U.S. debt is why this market sold off. I mean, the reality is we were in a free fall before that. So that only, helped the situation a little bit to the downside. But ultimately, the markets were already in flux, well before that. So with that, give us a call at 877-927-6648. When I think about, Bernanke speaking later this week, is there anything that he's going to say that we haven't heard before? Maybe he actually, sits up late at night kind of trying to come up with things that would really screw us as traders. With that, I'm going to jump over here to the next caller. We got Kevin in New Jersey about FAZ. You there, Kevin?
Yes, sir. How you doing, Don?
Good. How's it going today?
All right, good. I wanted to ask you, I follow on Twitter Dr. J, and one of his tweets yesterday was on the FAZ. He said he was trading it. My question is, with the wide spread on it, number one, and I don't understand the 3 times. Could you explain what the 3 times and 2 times, what that means?
All right, so basically, and this is just with all double and triple leveraged ETFs, for the most part, this is giving you an inverse relationship, so it's 3 times the bear. And the one that, for instance, FAZ, there's quite a few people, looking at FAZ. It's obviously the financials out there, but ultimately it's giving you 3 times the movement of the primary, but it's also an inverse. So, for instance, if its primary went up $1, this thing on an intraday basis should trade, 3 times that ultimately, but that's on a percentage basis. Okay, so it's and by the way, somebody pointed out something great. FAZ does not necessarily have wide spread; just moves very fast in this price range. So for the most part, FAZ is wildly volatile. If you take a look at FAZ over on the far right-hand side of the ThinkorSwim screen, it's showing 140% volatility in the September options. I mean, it's a $67 underlying trading 140% vol. That's kind of a concern. Now, the bid-offer spreads, the reality is this, they are kind of wide. They're wide for the FAZ, and people may disagree, but, listen, the market makers today have an auto-quote system. If they wanted to make this market 5 cents wide, they could, and they could do it very, very easily. They choose not to, and ultimately the reason is because there's edge for them. There's 40 cents edge. When you see markets, though, for instance, like I'm looking at the 70 calls, they're $9.30 by $9.70, you can fill very close to the mid in FAZ. There's no question about it. They'll give you a much better fill, but these markets are poised artificially wide in a period of heavy volatility to protect the market makers themselves and to give them a little bit of edge in there. So it is what it is. If you want to trade this, you're definitely going to have to be a little bit careful. The one thing I kind of caution away in these double and triple inverses is if you hold the underlying stock, the stock itself has a decay rate associated with it, and buy this stock right now at $67 on the button, that stock will literally start to decay away over time. And the decay rate in the stock is associated with the cost of carry as if you had owned, okay, the primary underlying itself, meaning that they're charging you for giving you 3 times, for the most part, the buying power. Does that make sense?
Well, not only the option decays, the stock decays.
The stock does have a decay rate.
Wow.
Like I trade TBT a lot. TBT is double inverse of the TLT. And if you looked at a chart over TBT over time, the chart itself always has a small decay rate associated with it, and it's not what we would consider time decay. It's actually a cost of carry decay, because for the most part, when you do any one of these triple levered or double levered ETFs, the ETF itself is designed to give you 2 or 3 times the buying power that you normally would have, and because they're giving you 2 or 3 times the buying power, they're charging you, okay, a fee for the cost of carry as if this thing were, for instance, 3 times the price. And there is a cost of carry and a management fee associated with all of these. So it's something to kind of keep in perspective. To be honest, man, I'm not a huge advocate of some of these double and triple inverse ETFs. The reality is,
I can get that from you. Also, if you were to do a weekly on this, I would imagine the beta would kick in about 90 miles an hour on this if the market didn't move.
Yeah. It's and
as far as depreciation.
40-cent wide weeklies. Here's the reason I'm not a huge advocate. If you're directional in nature right now, in the financials, if you're directional in nature, even in the bonds, sometimes it's easier to take positions, okay, in things like the S&P 500 with tighter markets. People go, but that's not what I want to trade. I want to trade, the financial markets. For the most part, everything is moving in relative tandem right now. I mean,
Can you hear me?
What's that?
Can you hear me now? Okay, go ahead.
Yeah, I can hear you. So everything has tendency to move in tandem right now. So when I look at, FAZ, I think to myself, I'm like, why not just trade E-mini S&P 500 futures? I mean, because ultimately they're moving inverse to the futures, and the futures are still going to give you a better bang for your buck. They're going to give you more buying power than even a double or triple levered ETF. It's not necessarily a good thing. But
so for a beginner, as far as that goes, you would stay clear of that until you did some more homework on it.
Yeah, you better be up to par to be able to trade, these double and triple levered ETFs. There's no question about it.
All right. One more question, Don, if you got time.
Yeah, fire away.
What would you do? I mean, what do you do in a market like yesterday? Fortunately, the market went up 200 points, and I bought a put, the 114 SPY weekly put. Unfortunately, I got out when the market was at 20 points up yesterday afternoon. But like right now, what do you? There's nothing to play in the SPY as far as I can see, because we should rally up going towards Bernanke. We could pull back. It's like I don't know where we're going. I have no clue.
I agree.
And it's like, what do you buy? You can't even. You don't know what to buy.
I mean, I'll tell you one thing. You're going to trade on a day-to-day basis right now. If you're going to trade on a day-to-day basis, you got to be nimble. You got to be on the trigger. Myself, if you don't trade futures, I would use spreads. If you're going to trade the weeklies, use spreads of some kind. I know it's not as glorious as buying a put and having the market sell off huge, but the reality is the spread will at least protect you, because directionally right now, nobody has any idea. I mean, I don't care what anybody says, support, resistance. In the end, this is all about right now the gold trade, the bond trade, and ultimately those are going to dictate a lot of what goes on. Yeah. So I'm sorry, I missed your last comment there. Still with me? I think you might have dropped off the line there. You still with me? All right. So we lost Kevin and you, but it's all right. We've got another caller here. So if we could, it looks like we're going to jump over here to Dante in Columbus. You there, Dante?
Yeah, how's everything going?
Good. You I can hear very well. I had a little trouble with that last caller being able to hear him. Yeah, fire away.
I can hear you too well, that's okay. Just got a question. Not that familiar with options. And when they talk about the volume, like where's your chart at the moment, what's the most popular option out there, or one of the popular options?
On a day-to-day basis, if I look at like order flow, like TD Ameritrade, ThinkorSwim, almost always number one is the spiders. So in terms of number of contracts traded through our system, it's going to be somewhere right around the spiders.
All right, as so far as what individuals bought today,
Yeah.
I'm trying to look at your chart and try to get an answer. Could you show the volume?
So I'll give you the reality behind this. So you can look at the number of contracts traded, like number of calls traded, or the number of puts traded. Meaning, on a day-to-day basis, you can look on ThinkorSwim and you can see, for instance, I'll pull up like volume and open interest, and I can see that tons of volume has traded here on the put side of the spiders, meaning the September puts. A bunch of puts have traded. So there are some people that try to infer a directional bias based on the number of contracts traded, calls or puts, but that's really difficult to be able to do. All right, and if you're looking right now at my screen, you'll see that there's a lot more put contracts. There's more volume in the put contracts than there are in the call contracts right now in the September options.
All right, just looking at your September 11s,
Okay.
September 11th, 107s.
Okay.
You got 6,360.
Yep.
Were what, bought today?
Well, that's traded today. So it's bought or sold.
Just as of today.
That's of today. That's the volume today. The total open interest, which is the number of contracts open, and that's always calculated at the end of the day. That's the only time the exchanges report it. It's 152,000 contracts traded of that, that's amazing.
Now, is that 152,100 lot shares, or just 152, maybe 100, maybe 500, maybe 1,000?
No, it's 152,000 contracts, period.
Correct.
So that's not actually numbers of trades, it's physical contracts. And if you look at 6,360, you might think that's a big number, but somebody could actually trade 6,000 contracts at one time. We do it all the time in our office. So we actually, we'll trade for other individuals out there, and we'll fire off. We have clients that fire off 5,000, 6,000, even 10,000 contract trades all day long.
But are they 100 lots, or could they be 1,000 lots or 10,000 lots?
Absolutely. That's how they'll do it, too. They'll say, hey, it's one order, it's 10,000 contracts. And if somebody traded 10,000 contracts right now, this volume would literally add 10,000 contracts to it. It'd be then 16,360. So the question I have for you is, why are you looking at the volume? Just try to.
No, I'm just trying to figure this out in my head.
Yeah. Well, the one thing I'll kind of caution you away from is, so let's say that somebody traded, literally, obviously one contract is 100 shares. Somebody was chatting in the room over here. So one contract is 100 shares. But the reality is this. A lot of people try to look and see if more puts trade than calls, then that's a bearish sign. But that's not necessarily true. What I'm basically telling you is that...
Well, they could be selling.
Right. They could be selling puts. But if you think about this, sometimes I buy puts, but I'm bullish. So think about that for a second. So why would I buy puts and be bullish? That's the question that you have to ask yourself as a trader. Is sometimes traders buy puts and they're bullish. And the reason is I'm buying puts because I'm already long the stock, and I'm using the put as an insurance product against the stock that I own. So a lot of traders do that. So all of a sudden you may see, tens of thousands of puts. Even if you know somebody's buying them, it doesn't necessarily help you because they could be buying puts. For instance, if I were buying right now the 110 puts, in the end, give me the right to sell the spiders at 110. Everybody thinks about buying puts as being bearish. Well, it's not. Okay, buying puts can be bullish. You're buying puts because you may own tens of thousands of shares of that stock, and you're like, hey, I just want to have an insurance policy at the 110 level. So you always have to look at the other side of the market. The other thing is sometimes people sell puts and they're actually bearish. So figure that one out. They're selling puts and they're bearish. And the reason they're selling puts is because they're already short the underlying, okay, and they're selling puts it's kind of like an inverted covered call. So I think I blow people's minds when I explain some of this, but traders, professional traders always look at that aspect in the marketplace. I remember, back to the floor trading days, is if earnings were coming out on some specific stock and there was somebody in the pit buying a ton of calls right before the earnings were coming out. Think about this. You got earnings coming out, for instance, let's say on like Google. I'll give you an example. Like if earnings were coming out on Google and they're going to come out right after the close, there's guys down in the pit literally buying calls before the earnings were coming out. Most of the traders in the pit assumed that that was then bearish for the earnings. Does that make sense?
No, I understand what you're saying so far.
Yeah, so basically call buying is always thought to be a bullish thing. Okay?
Correct.
But all of a sudden, somebody comes out and they start buying tens of thousands of contracts of calls right before the earnings announcement. So why are traders buying calls before the earnings? All right, they're buying calls because they're already short the stock and they're looking to protect to the upside. It's just there's always two sides to kind of that coin. So a lot of the times, like I look at options and I don't really get a lot of directional feel by looking at the options. That being said, once in a while you get some little stock called Joe's Tree Cutting Service or something like that, and one of those stocks shows extraordinary volume. You know, that could be interesting, and that might be worth looking at, but that's not my business. I don't go on kind of the witch hunt looking for little option trades that I can, play around with. It just takes too much time. For me, I'm just a logical trader. I like to trade things that are massively liquid and super tight bid-offer spreads, and that's what you get in a product like the Spiders out there. You all right?
But again, getting back to your 107s, that you have on your chart.
Yep.
That volume is 6,360 100-lot options.
Well, it's one contract, which is equivalent to 100 shares. So if you wanted to put this in terms of shares, all you do is multiply this by 100. If that helps, put it in terms of the equivalent.
So that's really not that many. 6,000 people.
Well, it could be one person that just traded 6,000 contracts.
Exactly.
Yeah, so you could take a look, and it's actually no, that's it's pretty decent volume here. I mean, we're only we're not even but halfway through the trading day. It's that's some pretty big volume. I mean, when you start to look and put this into reality, though, somebody's traded 35,000 or 41,000 of the 110s. That's pretty heavy volume. You're not going to see that in other underlyings. And to put that again in kind of a relationship here, let's take over something like gold. Gold isn't hugely in play right now. So let's look at the options in gold to get an idea. So gold's $180 underlying GLD is. Let's see how many contracts have traded over here. You don't see anywhere near that kind of volume of 40,000 contracts, and yet gold is kind of in play right now, one of the more liquid underlyings. You look at something like Intel. Everybody knows the company Intel. How many contracts did this thing trade today? We're only in the hundreds. Maybe the thousands here in the calls. So the reality is, I mean, the Spider volume is still absolutely massive in there. So again, try to keep everything in terms of contracts. It's, again, one contract is equivalent to 100 shares out there.
Understood. Okay,
Yeah.
Appreciate it.
All right, man, thanks for giving us a call. So with that, if you guys have a question and would like it answered live right now, we got plenty of time left. Give us a call, 877-927-6648. With that, a couple other questions have actually come up within the chat room, and I'm going to read them aloud here. And again, I'm sorry to Kevin if you're from Jersey. You got cut off a little bit earlier. It was kind of hard to hear you anyway, but hopefully you got all the questions answered there on your FAZ trade. So let's actually jump to another email that I've got, and it's actually a second part to Frank's email. And that is, so Frank was asking again, if there's no options offered for $50 stock, what determines the initial, pricing of options? Ultimately, anytime you're pricing options out there, in the end, people say options are priced by volatility, options are priced by time, options are priced by, this, that, and the other. In the end, an options price, although is affected drastically by time, the more time you have, the more the options are going to cost. Ultimately, in the end, option pricing is supply and demand. If everybody in the world right now, everybody in the world demands Spider options, what do you think happens to the implied volatility? It goes up, okay? But that is, the implied volatility going up is only an effect, okay, in effect, from the demand increasing, of course, for instance, for buying these puts. So if everybody tries to go out and buy puts, buying puts is an insurance kind of play, they buy puts that would actually raise up the implied volatility there, obviously making the options more expensive. So in the end, that's ultimately supply and demand. So there's another part to this question. Also, if you want to close an option position without executing, okay, or without actually assignment, taking the shares, what entity closes out the other side of your trade? All right, so let's kind of go through this. In every marketplace, all right, there are liquidity providers. So I want to make this really clear. In every marketplace, there's liquidity providers. You call them market makers. I call them liquidity providers. There's a market maker right now here in the Spiders making a market of the 118, the September 118 calls. The 118 calls of September are 235 to 237. That means right now, that market maker, if you post a bid and post an offer, and again, you have to, as a market maker today, post a bid and post an offer. If you post a bid for 100 contracts and post an offer for 100 contracts, you have to honor your 100 contracts on either side of the marketplace. And the reality is, today these markets are server-driven. So what does that mean for you? It means that there are traders behind that, but ultimately the server is just kind of on autopilot and it says, yeah, I'm willing to be 100 bid by 100 offered here. And they'll do that trade with you. So for the most part, if you wanted to get out of this trade right now, all right, you would be able to get out for right at the bid or the offer, meaning the market today or right this second is 235 to 236. It means you could be a buyer at 236 and the seller at 235, and somebody has to take the other side of your trade. So for every buyer, there's always going to be a seller. That's what a market maker or a liquidity provider is there for. You never have a worry that you're not going to be able to get out of an option trade. That being said, do not trade illiquid stuff. People always do that. They trade some stock called Joe's Tree Cutting Service. Nobody ever trades the options on there, and it's kind of ridiculous. I haven't pulled it up in a while, but I saw this, like Pandora. Pandora listed some options on here, and they're kind of wide. And listen, you're going to trade this, that's up to you. But for instance, Pandora right now is a $12 stock, and I pick on Pandora because they just IPO'd recently. If you look at Pandora, the $12 calls, they're $1 by $1.20. Good luck. All right, why do I want a 20-cent wide market? And people go, oh, but you might get filled somewhere in between the marketplace over here. Yeah, you might, and then again, you might not. So this market's $1 by $1.20. You might be able to go out there and buy those options for $1.15. Who cares? You know what? They're not traded in penny increments. The market's not tight enough. I don't care if you know everything about this stock. It's kind of hard to make money when you're giving up that much edge. And people don't think it matters, but if you give up 5 cents on the way in, you complain about commissions. Think about this. 5 cents in a one-contract trade is $5. That means you'd be giving up $5 on the way in and $5 on the way out, plus whatever your transaction costs are. But maybe you don't trade one-contract trades. Maybe you do 10 contracts. That's $50 on the way in, $50 on the way out. Keep things in perspective. To this day, clients give up, still to this day, more in the bid-offer spreads than they pay in commissions. And listen, every single day, I'm in the brokerage industry. We hear about clients upset. Hey, I had to pay this much for commissions, and I look at the account, and I want to flip out and tell you, hey, you stop giving up that much in the bid-offer spread, we'll fix your commissions for you. And it's a deal I've made with a lot of people over time. I say, go out there and trade some liquid products that make sense. Don't give up, a lot of capital out there. In fact, a lot of people trade, for instance, this product, the SPX. The SPX is the S&P 500 index options, one of the biggest products, obviously, out there. You look at the October options, markets are 47.10, for instance, by 50.10. There's a $3 wide spread. $3 wide spread in today's marketplace is insane. Like, I just don't understand why anybody trades this product. They go, well, I didn't know any better. Well, you could trade the Spiders, but the Spiders, you have to trade more contracts. You could also trade options on futures, the E-mini S&P 500 options on the futures, and ultimately the options on futures. Let's take a look at the exact same markets, options on futures, and I'm also looking at October options here. These markets are only 50 cents wide, and I'll tell you what, the E-mini S&P 500 options on futures, these things will actually trade right in the middle, meaning that there's almost no give up on terms of bid-offer spread here on the E-mini option. So the bottom line about this is just simply this: know your product. Know the product you trade. Be comfortable with the product you trade. Because market makers, listen, they're not running these server farms to not make money. If they can nick you in the bid-offer spread, they will. But ultimately, you trade liquid products. There is no give up off the theoretical out there. All right. So again, give me a call. We got plenty of time left. 877-927-6648. couple questions kind of came up here in the den, and I'm going to grab some of these. So let's take a quick look at this. All right. See if I can actually read a couple of these. All right, kind of backing up over here, and because I know some people had some questions, and I want to try to grab them. All right, so first question came up. Don, where are you at, okay, and going to cover your short gold position? So basically the bottom line is this. So Danny from Atlanta. By the way, Danny, if you are in Atlanta, I will be in Atlanta along with Tom Sosnoff on Thursday night. Shoot me an email if you're interested in going. By the way, that's anybody listening today. We're going to be out in Atlanta this Thursday, and it's myself and Tom Sosnoff doing kind of a ThinkorSwim, what we call trader show. They're fantastic. They started about 5 o'clock, go to about 9 o'clock at night. Beer, wine, liquor, food, and Tom and myself. It's good stuff. Anyway, my email is dkaufman at ThinkorSwim.com. If you guys are interested, you can go into that. So the question is, where are you going to cover your short gold position? The answer is never, Danny. I am going to hold my short gold position. I'm totally comfortable with it right now. Am I taking a beating on it? Absolutely. But the reality is, on my gold position, I'm not just short the underlying stock like GLD. That's not the way I operate. So I'll tell you exactly the way I operate here in GLD, and I'm actually going to pull it up. If you look at GLD, and I open up, for instance, the September options, I've been selling out-of-the-money call spreads and kind of staggering them. So, for example, right now, I mean, listen, I don't like to sell a call spread. Like, selling a call spread is a bearish trade. I'm not going to initiate a bearish trade on a day that gold is down almost $4. It just, to me, and when I say gold is down $4, I'm talking about GLD. Gold itself is actually down almost 40. Yay! It's happening for me, huh? Yeah, right now, when we're on the air live, gold is down 32.80 right now. So it wouldn't surprise me if you see gold in a one-day move go down as much as $100 in a day. It's not going to surprise me at all. But I'm out there selling out-of-the-money call spreads, and I've actually had to roll them into September. I've also got some October positions on. But, for example, I'll go out and sell, for instance, like the 183, 185 spread right now for a 75-cent credit. That's the kind of trade I would put on. So they're all defined risk trades, and in the end, I can hold them. I mean, I'll hold them until it makes money. If it doesn't make money, yeah, eventually I'll close them out. But I'm pretty comfortable in saying that, sooner or later, gold will trade down, and it is what it is. Again, if I've got defined risk and I'm comfortable with the amount of risk that I am defining, then why close it? People panic all the time. Listen, if I was short just the underlying stock, I'd have wet myself, okay? I would need, my little gold diapers alongside of me here. Nobody could hold that position, nobody that's sane. Then again, I was talking to Tom Sosnoff the other day, and he is kind of just short gold out there. So he is insane, and he does not need the diapers because he just does not care. Anyway, with that, I was showing you guys like a $2 wide spread over here, of course, in shorting gold. Again, I like that position. It might not be right for you. Some of you guys listening right now are totally gold bugs. You're long gold. I hear Tom O'Brien talking about gold almost every single day on the show. I like to take the other side of it. I'm a contrarian. I was born into a contrarian family. It happens to some of us. Other things here that I'm looking at. When I'm talking about being a contrarian, I'm a huge contrarian to the bond market. No question about it. I mean, the high tick, all right, is 141 and change, and we're at 139.20. The 141 high tick in the bonds came in 2008 and 2009 when we thought the world was coming to an end. The one thing I think we're going to learn in the possibly the days, the weeks, months, and years to come is that people think that bonds do not have principal risk. You're going to be wrong. Right now, holding a 10-year note, the 10-year note, to be able to make 2% off of a 10-year note is absolutely ridiculous. Sooner or later, somebody's going to figure out that some companies, they pay this thing called a dividend, and the dividend is more than 2%. It only takes one guy, one big trader, to realize, hey, why am I sitting in a 10-year note making 2%, okay, when I can go over and make 5% holding, XYZ stock over here, and then the money will start to flow out of the bonds, and they will be blood red for a period of time. So sooner or later, these bonds will definitely downtick. Again, it's it is what it is out there. Financial sector is actually ticking up today. Other than I haven't looked at Bank of America since we started talking. Bank of America is almost flat on the day. It was kind of holding down some of the financial sector. Obviously, gold trading off. Bonds are very off a nominal amount. Again, sooner or later you see bonds one of these days down big. You're seeing a pretty big down day, though, here in gold. Obviously, E-mini S&P 500 futures are up 25 on the day. So quite the rally going on right now in this marketplace over here, of course, in S&P 500. So with that, kind of wrap up here for the next few minutes. Sorry, I'm kind of typing a couple of messages and talking here as well. Got all kinds of good things going over here. Again, S&P 500 futures up 25, NASDAQ futures up 58 and change. VIX now is off $4 in the day. You know, in this particular rally, I'd expect to see the VIX sell off a little bit more than it is right now. I'll feel a little bit more comfortable this rally is real when the VIX is more down in the 35 or even 32 range. Oil's actually up $1.72 on the day. Again, bonds are barely down, ticked over here. And gold. Gold is also kind of the story of the day. If you guys looked gold in the middle of the night, it traded as high as $1,917. Now is trading $1,858. Of course, you know, I've talked about this. Yeah, I'm definitely got some short positions on gold, short bonds over here. If it doesn't make it any worse, I'm also long a little bit of oil. So, wow, I've been on the wrong side of almost every single trade. But again, I'm a contrarian. I'm used to holding positions in the face of adversity, and I kind of like it. Okay, so anyway, with that, a couple of questions are also popping up here in the day. I'm going to try to grab those coming into to next week and so forth, because we've got to wrap up the show right now. So the options hour every Tuesday at 12 noon Eastern Standard Time. My name is Don Kaufman from ThinkorSwim from TD Ameritrade. Again, join me every noon Eastern Standard Time at Tuesdays there, and we'll answer your questions live. Or you can also shoot me an email at dkaufman@thinkorswim.com. We'll get you guys taken care of live on the show. We'll answer some of those email questions. So on behalf of everybody here at ThinkorSwim and TD Ameritrade, thanks a lot very much for joining us today, and be back again next week. And thanks a lot, everybody, and bye-bye.